As a real estate investor, when you decide to invest in real estate and then make the decision to sell your rental property, most times you will have a gain on the sale of the property. This directly results in you paying capital gains taxes to Uncle Sam. By you, as a taxpayer, doing what we call a 1031 exchange, it provides an exception to this by deferring the taxes on the gain of the sale of the property, by allowing you to reinvest the proceeds in a similar property or properties as part of a like-kind exchange. So what is a 1031 exchange? So a 1031 exchange or a like-kind exchange allows real estate investors a way to defer capital gains taxes by taking the proceeds and investing into another similar property. For example, James is a real estate investor who owns a rental property that he bought for $200,000. His rental property, we're going to call this property A, has appreciated to $350,000 over the years. If he decides to sell property A, he's going to have a $150,000 gain. This is what he would normally pay capital gains taxes on to Uncle Sam. So in order for us to figure out what is the exact capital gains taxes that he has to pay, we first have to take his basis, which is what he bought the property for, which is $200,000, and subtract the fair market value, what the property is worth, which is $350,000, and you get a gain of $150,000. So his capital gains tax is 15%. So we're going to take the $150,000 gain that he has and multiply it by 15%, and that equals $22,500. This is how much capital gains taxes that James is responsible for paying Uncle Sam. Now, if James decides that he does not want to sell the property right now and pay the capital gains tax, he has the option to do what we call a 1031 exchange. So while selling property A, he goes and identifies another similar property. We're going to call this property B for $350,000. This allows him to reinvest the proceeds from property A to property B, allowing him to defer the $22,500 gain on the sale of the property. Now, when it comes to like-kind exchanges or 1031 exchanges, there are 4 kinds of exchanges. You have the improvement exchange, the simultaneous exchange, the deferred exchange, and the reverse exchange. In an improvement exchange, you would use the exchange proceeds to not only buy the replacement property, but to fund improvements or constructions on this particular property. The improvements must be completed by the end of the exchange period. Now, the easiest of all the exchanges is the simultaneous exchange. This is where the property that's being sold and the replacement property, which is the property that you are acquiring, is exchanged at the same time. A deferred exchange or starker exchange is where you will sell your property, then identify replacement or replacement properties within a specific time frame by working with a qualified intermediary. A reverse exchange or a reverse starker is where you will buy your replacement properties first before selling your property using an exchange accommodation title holder and a qualified intermediary. With any exchange, you as a taxpayer cannot touch the money. Today, we're going to discuss deferred exchanges. For example, Jay has a duplex that he rents out each month that he originally purchased for $150,000 that has now appreciated over the years in value to $500,000. Jay decides that he wants to exchange his duplex for more real estate. He goes and identifies properties for his like-kind exchange. He finds a piece of land for $100,000, a residential rental property for $150,000, and he identifies another duplex for $250,000. The total value of the replacement properties, the land he identified, the residential rental property, and the duplex totals up to $500,000, which is equal to the value of Jay's original duplex. By structuring the exchange this way, Jay is taking advantage of the 1031 exchange rules. allowing him to defer taxes on the appreciation of his duplex. Now, if Jay all of a sudden decides he wants to sell those replacement properties, then the capital gains taxes on the appreciation of the replacement properties would be due. Now, with the deferred exchange, you need what we call a qualified intermediary. This is the person that you're going to be in communication with very heavy when you're going through this process. So what is a qualified intermediary? A qualified intermediary is a third party that helps you and guides you during the process of a property exchange by holding on to the sales proceeds, making sure that you as a taxpayer don't directly receive the money, and make sure that you follow the rules for a tax-deferred exchange. You as a taxpayer cannot have direct control over the funds. If you do, it will disqualify you from being able to use the 1031 exchange. So basically put, if you are selling a property, you need a qualified intermediary. This is standard practice for the reverse exchange and the deferred exchange. So who cannot be a qualified intermediary? A qualified intermediary cannot be related to you. They cannot be your accountant, your real estate agent, or your investment banker, just to name a few. So what are the rules and the steps that you must take in order to have a successful 1031 exchange? There are 3 very important steps that you must take when it comes to a 1031 exchange. Step number 1, you must complete the sale of your existing property. This is known as your sale date. This is where the qualified intermediary accepts the proceeds from the sale of the property. Step number 2, you have 45 days from the date of the sale of the property to identify replacement properties, according to the 3 rules that we will get into later. During this time, your qualified intermediary transfers the proceeds from the sale of your property to an escrow account so that you can now purchase the replacement properties. Now for step 3, you have 6 months, which is 180 days from the sale date to complete the purchase of the replacement property. There are absolutely no exceptions to this 180-day rule. Your qualified intermediary must not hold the funds more than 180 days. So how do you identify your replacement properties that we spoke about in step number 2? So you must describe the property. You do not have to put the legal description. Something like an address would work. So just a quick recap, you have to complete the sale of your existing property, which will give you your sale date. Once you do that, you have 45 days to identify your replacement property. Then you have 180 days from the sale date to complete the purchase of the replacement properties. So there are 3 rules that we must use when it comes to identifying properties, and that's called the 3 limitation test. Test number 1, you have to identify replacement properties regardless of their fair market value. Test number 2, you can identify an unlimited number of properties if the total fair market value purchased is less than 200% of the fair market value of the relinquished property. And last but not least, test number 3, you can identify an unlimited number of properties if you acquire properties valued at least 95% of the fair market value of the properties identified. Out of all 3 of these tests, you only have to meet 1. So for example, let's say Jay, that we used earlier, qualifies for test number 2. Since Jay's duplex is valued at $500,000, he is allowed to identify multiple replacement properties as long as the fair market value of those properties does not exceed 200% of the relinquished property. This means that Jay can identify multiple replacement properties with a combined fair market value of up to $1 million. So in order for you to calculate the 200% of the fair market value of Jay's duplex, you would take the $500,000 and multiply it by 2%, which is $1 million. Now remember, gain that has been deferred in a like-kind exchange is tax deferred, not tax tax-free. So who can qualify for a 1031 exchange? So generally speaking, if you as a taxpayer is the one that's giving up the property or relinquishing the property, then you need to be the one that's actually acquiring the property. If you are a limited liability company or an LLC, you are considered an individual. If you are an S corporation, a C corporation, an owner of investment or business property, trust, or any tax-paying entity, you can take advantage of the 1031 exchange, as long as you do not change the taxpayer. What this means is that you as a taxpayer cannot exchange property that's in your name for property that's in an S corporation's name. So what property can be exchanged? So the property must be the same in nature or character, and they can differ in grade or quality. They can be improved or unimproved, like buildings that can be exchanged for land. Now, both properties must be within the United States, or both properties must be located outside of the United States. For example, if you are exchanging a duplex in Texas, you can exchange it for a rental home in North Carolina. Both properties are located within the United States. You cannot exchange a rental flat in France for a rental property in Texas. Property within the United States is not like kind to property outside of the United States. So what property cannot be exchanged? Property that cannot be exchanged is property used primarily for personal use, like your primary residence, a second home, or even a vacation home. Section 1031 does not allow the exchange of inventory or stock in trade, stocks, bonds, notes, or other securities, or debt, partnership interests, or certificates of trust. You as a taxpayer cannot exchange your principal residence for someone else's principal residence. It is not allowed. Now, if you are a real estate investor and you specifically fix and flip, this concept is not for you. The IRS considers property that you purchase to be inventory. And according to IRC Section 1031, you are not allowed to exchange inventory. So is there a limit to these exchanges? There is no limit to how many times you can perform a 1031 exchange. This is how the wealthy continue to build their wealth, by taking one property and swapping it for another, or two, or three, or more, and continuing to do 1031 exchanges and defer the taxes on the property until they die. This allows them to pass their wealth on to their heirs tax-free, giving their heirs a step up in basis. So you learned today what is a 1031 exchange, the different types of exchanges, the specific timeline that you must follow using a qualified intermediary if you're doing a deferred exchange or a reverse exchange, and how you can build wealth doing 1031 exchanges over and over and over again. If you found any value in this video, please let me know in the comments if you think utilizing a 1031 exchange will save you money on capital gains taxes. From Everlife Accounting Group, my name is Karina, and thank you for tuning in to another episode of Financial Sense.